Okay, so today we're going to go over just a little bit on just some different business structures. I figured since we're planning as an entrepreneur to hopefully start a business one day, we ultimately have to know what form of a business structure we're going to open, so, or what business structure we're going to roll with whatever business we start. So I figure we'll just talk a little bit about some of the different forms of business structures today. And I don't believe it'll be too long of a lecture. So obviously, once I'm finished here, everyone's free to do whatever. But I know they're having that UN thing over at the student center where they have free food and stuff. So I might head over there and check that out. I don't know if that's something y'all are interested in or anything, but just figured I'd throw it out there. But so business structures. This what comes to mind when we talk about business structures? I'm probably gonna see a little. No, I'm just block that out. So what usually comes to y'all's mind when you think of business structures?
Maybe like revenue models, how they're going to make the money.
Okay, not necessarily revenue models.
I think it's just like different forms in general. So I mean, some businesses are strictly online with e-commerce, and then some are strictly like in-person interaction, like selling stores.
On the right track, but we're more concerned with business structures like the legal structure of a business that is going to ultimately have tax implications and stuff of that sort. So I mean, I know y'all have heard of different.
Yeah, it's like sole proprietorship,
right?
LLC, partnership.
Right. So that's probably just maybe that was my bad on how I presented the question. Maybe that just kind of a broad business structures can be broad. It could be revenue models or whatever. But in this sense, we're talking about like LLCs and partnerships and that sort. So the business structures, obviously, at the inception of a business, a decision has to be made as to what sort of a business entity we're going to establish. Both the legal and tax considerations should be taken into account when selecting which business structure we want to have. And it's ultimately going to determine which income tax return that we have to file with the IRS at the end of the year. So, what different forms do y'all know of? Before I go to the next slide, that is the different forms. Do y'all know the different forms?
LLC, sole proprietorship, partnership, C corporation, S corporation.
Yep, that's your main ones. You already nailed that one. So the common forms, those are most common forms. So you have your sole proprietorships, partnerships, corporations, S corporations, and your LLCs, which are your limited liability companies. So we'll start off with the sole proprietorships. It's obviously just someone who owns an unincorporated business by herself or himself. If you're a sole member of a domestic LLC and you elect to treat the LLC as a corporation, then you're not a sole proprietor. Obviously, if you elect to be treated as a corporation, then you're not an LLC. Sole proprietorships are a tax conduit, meaning that the performance of it is just going to ultimately pass through to the individual's tax return, the Form 1040, I believe the U.S. individual income tax return. So that's what I mean by a tax conduit. And a lot of these organizations are just a tax conduit, whereas the performance is actually going to just be a schedule that attaches into your normal 1040 that anyone else that works for someone else that's an employee of a company would file at the end of the year with their W-2s and stuff like that. So a sole proprietorship is just in all essence just a tax conduit if it's not set up as elected to operate as a corporation. Okay, next, partnerships is obviously the relationship between two or more people that are taking on, joining forces pretty much to run a business or whatever it might be, just teaming up with one another. They obviously are going to make a contribution in the form of money or a property or whatever it might be, both, and they hopefully, obviously, they want to get a return or make money off whatever they're contributing to the partnership. Now, the partnership must file an annual information return to report the incomes, deductions, gains, and losses from its operations. And the annual return of income for the partnerships is Form 1065, the return of partnership income. And obviously partnerships are not subject to income tax, so the actual structure, the business itself is not subject to income tax because the profits and losses are passed through to its partners. So once again, same thing, partnerships are tax conduits in essence. So they're just, it's passing the performance on to the individual for it to be filed on the 1040. And obviously each partner just includes his or her share, like whatever their portion is within the company. So if they have a 20% stake in the partnership, then if they have if the income's 100,000 that year, then their share is going to be 20,000. That's what they'll report on their 1040. So it's proportionate to their ownership. Partners are obviously not employees, and they should not receive a W-2 from the partnership. Whereas, if you work, anyone that works for a company knows that at the end of the year, by the end of January, you receive a W-2 or a 1099, something like that. But we're not employees, so we're not receiving a W-2 or a 1099 in that state, because we're obviously not independent contractors either. So no W-2s, no 1099s. Instead, the partnership must issue copies of the Schedule K-1, which is part of the Form 1065, to the partners. And that'll ultimately show, if you recall, Form 1065 is going to be your income form for the partnerships that we had right here, partnership income. So Schedule K-1 is just a schedule off that form showing whatever your income is. Everyone good on sole proprietorships and partnerships? Okay, so corporations is the next one. Obviously, in corporations, investors are gonna invest either money or give land or both in that regards in exchange for a share of the company or some of the stock of the actual corporation. Corporations usually take the same deductions as sole proprietors to determine what their net income is going to be, but they can also take other deductions that sole proprietors can't usually take. C corporation is recognized as a separate tax-paying entity for federal income tax purposes. So obviously, as the corporation earns its money and pays its dividends and stuff like that, it's gonna have to absorb the taxes from whatever action that it has. Corporations are subject to double taxation. So what I mean by that is, as a corporation earns the money, whatever it produces is going to be taxed as an individual. It's looked at in the eyes of the IRS as an actual individual. So it's going to be taxed on its own based upon its production or its earnings. And then once again, when they distribute the earnings to the shareholders, that's taxable as well. So that's the little double taxation that corporations are subject to. And obviously, the corporation cannot make a deduction for distribution of dividends to the owner. So that's kind of crappy in a way. They're definitely getting hit from both ends here. And obviously, shareholders cannot deduct any losses on their returns as well, because they're separate entities there. So that's how the IRS determines that. The form to file with the IRS for corporations is 1120, the U.S. corporation income tax return. And obviously, corporations produce a lot of money, for the most part, have a lot of activity. So they're also usually required to make estimated tax payments throughout the year, and that's usually done quarterly. And it's completed using the Form 1120W, estimated tax payments. And that's also a good thing too. You want to make these estimated tax payments, because a lot of times if you don't, you could be in a lot of trouble at the year end, because you might not have the cash flow or the actual capital to actually pay your taxes. And that's another reason why the IRS actually makes you make estimated tax payments, because they want to make sure that they're getting their money when it's due. So just a good thing to keep in mind for corporations, that they have to do the estimated tax payments. Everyone good on the actual, this is a C corporation here. Everyone good on the C corporation? Okay, the next form is S corporations. And obviously they elect to pass the corporate income and losses and deductions to that of the shareholders for federal tax purposes. So that pretty much makes an S corporation a tax conduit, because it's going to be allocated out to the shareholders proportionate to their investment, and they're going to just attach a schedule on their 1040, just as the other tax conduits would have. And it's good to know that the shareholders of the X corporation, once their income has been allocated to them based upon their shares, they pay taxes based upon their individual tax rate. So that's how the tax rates came up with for the S corporation's revenue that's allocated out to these shareholders. It obviously allows S corporations to avoid that concept of double taxation that C corporations are subject to, but they are still liable for certain gains and losses at the entity level, although the earnings are taxed, on the individual level. Obviously, the corporation must meet certain requirements in order to qualify for an S corporation. It must be a domestic corporation, have only allowable shareholders, so it can only be individuals, certain trusts, and estates, and it cannot be a partnership, a corporation, or a non-resident alien shareholder. So very important on the characteristics of the shareholders when wanting to be a shareholder of an S corporation. It cannot have more than 100 shareholders, so it's going to have a small amount of shareholders in terms of your publicly traded corporations. Only have one class of stock because certain companies, the bigger companies, will have different classes of stock offerings that they offer to the public. And it cannot be an ineligible corporation. The ineligible corporations would be insurance companies, domestic international sales corporations, and certain financial institutions. So there is certain regulations against certain corporations actually being able to become an S corporation. And if ultimately, if you want to become an S corporation, then all the shareholders have to sign and fill out the Form 2553, an election by small business corporation. So that's what you have to do in order to, if you meet those requirements, in order to become an S-class corporation. Okay, and last is the LLC, the limited liability company. This is actually going to be regulated by state, so it varies by state in terms of what is able to be operated on, or how you can run your LLC. And obviously, each state may be subject to different regulations. And the owners of the LLCs are referred to as members, so that's what they're referred to. Whereas a lot of times, like corporations, there's officers and stuff like that. So LLCs is going to be members. Most states do not restrict ownership. Members may include individuals, corporations, other LLCs, or foreign entities, so a lot more lenient in terms of LLCs than that of S corporations. There is no maximum number of members, and a lot of the states also permit just a single member, so just a sole owner or one owner of an LLC. Certain types of businesses generally cannot be LLCs. Banks and insurance companies are prohibited. Why do y'all think that banks and insurance companies would be prohibited as practicing as a LLC? Think about the nature of their business. What is the relationship between a client and a bank?
They're holding their money.
So the bank is in essence the client's agent, because they do what you tell them to do. If you tell them to deposit money into the account, they do it. If you tell them to transfer it, they do it. If you make a withdrawal, they pull your money out of the system and give it back to you. So in essence, they're acting as an agent. There's an agent relationship between them. So if you're giving them money to hold on to, and by law they only have to hold on to 10% of your reserves that you put in, and they loan the rest out, then why couldn't they be an LLC? Or insurance companies, we're paying them for a service in case something would happen. And then think about the nature of those businesses, and then think about the nature of what an LLC really means. Like,
I guess you got
whoever, it's fine.
Well, I guess banks and insurance companies, if they were to mess up and do stuff seriously wrong in their practices, then you wouldn't want them to have limited liability. You want them to have full liability.
Right, you'd like to have full recourse,
Right.
against whatever assets the bank has of yours. So if that was the case, they could just be a bank operating as an LLC or an insurance company. You could just buy in or give them that money, and they can just be like, oh well, sorry, we're limited on our liability to it. I hate to tell you, because of the laws of the LLC how they can operate. So that makes sense. That's why usually people that act in a fiduciary capacity in different aspects, just based upon the nature, usually obviously insurance companies and banks. So does that make sense why they would be prohibited from operating under this form of a business organization? Depending on the elections made by the LLC and the number of members, the IRS will treat the LLCs as either a corporation, a partnership, or an LLC's owner's tax return, which is a disregarded entity. So the domestic LLC with at least 2 members is going to be classified as a partnership for federal income tax purposes. They can file Form 8832 and affirmatively elect to be treated as a corporation as opposed to an LLC. So that's where that first line when we were talking about the different forms of organizations, if they elect to be a corporation, that's the form that they would use if they would choose to do so. And an LLC with only 1 member is going to be treated as an entity disregarded as separate from its owner. So what's that mean? As an entity disregarded as separate from its owner?
It's gonna have to file its own taxes.
Yeah, it's gonna pass through. He can't disregard that entity. It's disregarded as separate from its owner. It's not going to disregard that as separate. So everything's going to pass through. So in essence, it's going to be treated as a tax conduit. Same thing as the other ones if it's only 1 member. Obviously, it would have to because if he's the owner of it, the only person, then it's all gonna flow to him anyways. So, and just as with 2 or more members classified as a partnership, the individual can also file Form 8832 and elect to be treated as a corporation as well. And the LLC that doesn't want to accept this default federal tax classification or wishes to change its classification, obviously uses that Form 8832, the entity classification election, and they can elect how it'll be classified for tax purposes. And just a little bit of rules here on it. Usually the election specifying the LLC's classification cannot take effect more than 75 days prior to the date of the election being filed, and it cannot take effect later than 12 months after the date the election is filed. So just a little bit of time frames there, and that relate to Form 8832 entity classification election. So like I said, I knew it wasn't going to be that much to go over as basic stuff here, but I think it's important to just bring it to everyone's attention. If they're wanting to form a business, as an entrepreneur, you obviously have to at least know this is one of the most important steps is determining what form you're going to operate under. Obviously, what form, and like I said before, having an accountant and an attorney helps a lot as well. So this is just a little bit of the legalities of starting a business, and it is really important to know which form because it could really make or break you in terms of what you're able to deduct and tax implications. So it's just really important to keep these in mind and make the best decision you can. Does anyone have anything they want to add to it or take away? Or
Yeah, I mean, as far as I've heard multiple opinions on like complexity of starting an LLC. In your experience, or people that how easy or how difficult is it to start one? Because I know some people say like, I'll just go to a lawyer. They can fill out a form for like a couple $100 and then you can be set. Some people is like, it's just a simple process where you go out, just fill a little bit of information. But do you have any?
I don't think it'd be too bad or too like tedious of a process, I guess you could say. I think a lot of it's situational. I think obviously because LLCs varies by state, so obviously depending on what state you're going to go to try to get an LLC, to run your business, that has a direct effect. So I'm sure some states are more difficult, and more burdensome than others. And I think a lot of it might be just what type of a business you're going to run as well. Obviously, if you're kind of in the gray area, like maybe you kind of have some characteristics of a financial institution and stuff like that, maybe you kind of have characteristics of insurance, stuff like that might be a little more difficult. But overall, I don't think it'd be too difficult. I think the main things you'll run into is the differences by state statute, and just depending on what your actual business itself is, it will be your two biggest determining factors on the difficulty in actually being able to run under that form of a business organization. And LLCs they're probably the newest form of a business organization as well. They're a newer thing. They've been around for a while. I mean, they're not like really new for our generation because we've heard of them, but they are a newer form. So that's another thing to take into consideration. They do vary by state, and they're newer, so a lot of the stuff's still being evolved and developing. And I think that's probably why it's not a uniform set. Myself personally, this is just me speculating. I think that's probably a big part of why it is regulated state by state, because it is a newer form and it hasn't had the time frame or the duration to actually be a uniform set of a business form like a corporation and stuff like that. Usually is. Anything else? That's a good question.
I'm a little curious, why is the C corporations like subject to double taxation and the S corporations aren't? Like, why, it makes me wonder why anyone would want a C corporation instead of just go with the S corporation every time.
Right. Well, a lot of times you have to be a C corporation because remember there's that list of like requirements that you have to fulfill, because a lot of corporations are too big and too powerful to be classified as an S corporation. And ultimately, yeah, you would want to avoid double taxation. No one likes to be taxed twice, you know. And a lot of C corporations don't give dividends because of that. A lot of times it's fraud, and they just reinvest it. Most of them do. I mean, it just depends on how they choose to operate it. But I think the main thing that keeps people from wanting to be an S corporation is the fact that they just can't meet the requirements. Because obviously, if they could keep that company from being subject to tax itself, then they're going to try to do whatever tax shield they can. But that's why they have those those stipulations in line to keep people from benefiting from the S corporation status, And the main difference is because, the S corporation is just a pass through, and the C corporation is its own entity. A lot of times legalities, like the legalities involved in it, could be another determining factor. The liability is probably different. And once again, I'm speculating here on business law here. The liability I'm almost sure is different in terms of a C corporation as opposed to an S corporation, because it stands as its own. So you're limited. So the actual shareholders themselves can't be sued if it's a C corporation, because it's its own entity. So you can actually sue a corporation and not the shareholders. So the corporation is the one who takes the hit there.
But an S corporation, you can sue like the people behind
I'm pretty sure the S corporation you can sue the actual shareholders. I'm assuming you can. I'm not totally sure, but I would say that's another huge fact in choosing a C corporation, because of the protection of law, because you're totally separate from that entity, whereas the S corporation, it just passes right on through to the shareholder. So they're in essence more responsible because they're benefiting directly from the actions of it, whereas the C corporation, you're not. That corporation is benefiting directly, and the only way the actual shareholders get to pull that value out is if they receive dividends. So that's my take on it. I could be missing some points, and I'm sure there's a lot more to it, but I think those are the main points on why someone would be a C corporation as opposed to the S. Any other questions?
Is a business allowed to transition from one, like an LLC to like a corporation?
Yeah, you can switch. As businesses evolve and start, because usually a lot of businesses are going to start as a sole proprietor. My father, I know he started out as a sole proprietor, and now he's an LLC. He switched to an LLC, and the reason he switched is because of obviously the liability factor of it. Because as a sole proprietor, he was liable. If someone came in, he sells cars and has a paint and body shop. So if his customers come into his shop and fall and trip over a piece of equipment, as a sole proprietor, he could lose everything because there wasn't a division protecting him. But as he did an LLC, he's limited as to what his liability would be. But tax implications didn't change for him because you know, he's a one owner. He does have employees, but one owner, and you know, so it still just passes right through to his 1040 just as the LLC, but he gets the benefit of, you know, the legal protection of operating under that form of a business. Now, obviously, there's probably like fees incurred that are a little different in order to maintain that status, a little different than that of a sole proprietorship and stuff like that. So, as far as if we were going to want to start a business, who would we get in touch with within the state in order to get this rolling, to get a like your DBA, like you know everyone knows what DBA is in terms of a lot of times there's like an actual name, like a corporate, like a charter or whatever, and DBA. For example, like the Rail Yard. Does everyone know what the Rail Yard is? The restaurant downtown, Bluefield Restaurant. It's actually called Double Vision Ventures, DBA, the Rail Yard, doing business as. So in order to get this going and to get all this stuff set up, you would go through the Secretary of State and get on their site, and then go from there. And obviously that's how you go about starting your businesses and making sure that your name that you want to use has not been taken already within the system and stuff of that sort. So that's another little insight if people want to actually get started. You start by searching the Secretary of State, and that's a good starting point to know if you can use that form in that name. Anything else? Everyone good? So yeah, that's just some different forms of business here, and like I said, just the main thing is the legal and tax implications that come out of each one. Because ultimately, as business owners, we want to protect our investment and not be subject to, you know, litigation that could cause it to go under, you know, because that could ultimately put us out of business. So that's just really important to know which business structure just suits your needs the best when running a business. So that's it, and that's all I have. That's all I have for everyone. I hope everyone has a good day.